I knew you were going to ask me about baseball, and I've been so busy with the US Open that I haven't had time to study what's going on. But Tom, there's still a lot of opportunities across markets right now. What we're watching is that essentially the US has to earn every bit of the returns. Earnings season's been awesome. The
Yeah.
economic surprise index is perking up. US equities are doing fine, but we meanwhile we have European stocks on fire. China is the technical titan of the world so far year to date, up 51%. Guess what their earnings growth has been this year? 0.0%. So we're seeing multiple expansion across
Right.
non-US markets. We're seeing sentiment drive them. US is holding in there, but we still think that the earnings engine in the United States is the strongest, and there continue to
There
be
we
better
go.
relative opportunities
That's the
here.
Emily we know and love. Because the foundation here, folks, and this is the John Hancock. Are you an old or new John Hancock? That's like there's two skyscrapers in Boston. Which one are you in?
I never worked in that original building, but I have been with the firm for 21 years.
Unbelievable. Emily, as simple as I can, retirement money, the
Yep.
quiet money, they have to participate. And you're still saying quality large cap is a place to be?
Yep, quality large cap momentum by far has been the best performing factor. For those that aren't familiar with it, it's just buying what's been up over the last 6 to 12 months. We're not only seeing that in Europe, but also in the United States. Meanwhile, quality's been a bit left for dead here. These are companies with great balance sheets, lots of cash, a limited need to take on debt in order to grow. We still think that's where the opportunities are. The United States has an abundance of quality companies, but the other area, Tom, that's been left for dead is bonds. High quality bonds are up year to date. They're actually working as diversifiers in portfolios. And we think that there's more room to run here on a total
Okay.
return basis. The bond market is not sniffing out the disinflation that we think is coming here because of the myopic focus on political developments. We think there's a missed opportunity there for investors who are
Oh,
sitting in cash and could move out the curve and embrace high quality
do you know
bonds.
how much it's like chewing glass for the gloom crew to listen to Emily Roland? I
Exactly.
mean, she's like Ben Ladler. They've been
Yep.
so right.
Right.
It's sick.
Yep. One thing that has not bounced back, or one asset class that, or one secure asset that has not bounced back, is the U.S. dollar. What do you make of the U.S. dollar?
It is just remarkable to see the dollar down almost 10% year to date, even more from a versus the euro. A lot of this, again, is based on sentiment and political developments. When the Fed independence comes into question, where do we see it in the dollar? There's a fear of investors owning US dollar based assets given the political dynamics. We think that's overdone. And in fact, US economic growth, I'm not saying it's great, but it's improving right now. It's kind of like my son just started his sophomore year in high school. Like his grades are like going to be okay, like not great. But we're looking at an environment where the dollar should be strengthening, given those relative economic trends with Europe starting to see their economic surprise index rolling over here. So we do think that one of the key elements that's been driving that outperformance of international equities has been the currency development plus multiple expansion. We actually see that fading here as markets can start to think about those relative differentials and stop the focus on politics.
And Emily, you mentioned earnings, and in hindsight, the second quarter earnings were much, much better than expected here. Can you extrapolate that out for the back half of this year into next?
Yeah, I mean, the bar actually is not that high going into the next couple of quarters. Analysts are penciling in mid-single digit growth. I think 2026 looks a bit elevated, around 15% expected there. That probably is a little bit more difficult to get to. But again, we do think that these higher quality companies have the
Yeah.
ability to deliver on these earnings estimates, and that's a key reason we think there remains opportunities.
I mean, I know at your shop you're not doing so much stock by stock security analysis, but I just did a wicked fancy technical chart on NASDAQ 100, and the pullback is comical. I mean, there isn't a pullback, folks, is the punchline on a monthly chart. When you study the spirit of this for investment of retirement capital, is the
Yeah.
mystery about the revenue line or somewhere down in the earnings statement?
I think it's really looking at margins. So when you think about top line revenue growth, it actually surprised on the upside this past quarter. I think that's one thing a lot of people didn't really think about. Companies can continue to pass on some of these higher prices. We're seeing that in the revenue growth. The cost of capital, though, is still elevated. Everybody's expecting the Fed to cut. It might not be as much as investors expect. So companies are going to need to contend with that higher cost of capital. Margins are probably going to start to shrink. If you're a company whose margins are shrinking, you can either raise prices or cut costs. And we think companies are more likely to cut costs. We'll see that transmitted through the employment side of the Fed's mandate here. So we want to look for those companies that have a better chance of maintaining those margins. Again, not to repeat myself, but those high quality companies make the most sense in that environment.
Emily, so in the world of fixed income, how much credit risk are you suggesting clients take these days?
We really prefer high quality duration. Investment grade corporate bonds are really the sweet spot to us in terms of those elevated yields. The high yield bond market is just not pricing any risk in at all. Like, wake me up when high yield bond spreads widen. We're still below 3%. The
Right.
high yield bond market barely yawned in the midst of some of the recent volatility that we've seen. So, yields, yeah, they're just below their 20-year averages, but spreads, again, below 3%. It's almost the tightest we've
Right.
ever been. It was 233 back in 2007. So I think some credits
Right.
okay. But we're really not reaching for risk when you have the
Right.
ability to get a mid-single digit return out of high quality
Emily,
bonds.